Okay, guys, what we're going to be doing now, so we're going to get going. We're gonna cover, so you asked me to cover C, D, and E. I will start with D, okay, because C is weighted average cost of capital. We did quite a few weighted average cost of capital. I think we did 2 already, and it's right on the YouTube channel that you can watch. So if you get there, we will do it. I don't think part D is 25 marks. So the 25 marks will probably take the full 2-hour session. So I'm not 100% certain we'll get to this part part C. Then E is a 5-marker. We can see, okay, can see what it is. We can quickly chat on it. But I want to focus on part D. Now, like I said, the scenario is 11 pages, or let's say 10 pages, because the first page is some other stuff. 10 pages, we won't be able to read a full 10 pages. Okay, it's way too much information. So what we will do, we will focus on reading just the section relating to part D. Like I said, majority of the information will be under that section, and there may be instances where we will need information from elsewhere in the question to complete. So just keep that in mind. Most likely we will need some information elsewhere in the scenario, but majority of the information will be under that section relating to part D. So we'll just focus on that. And when we need any further information, we can look within the scenario. Because if we're going to read 10 pages, we're going to read here for 45 minutes, I don't know, for a very long time. Okay, so I'm going to just focus on reading the section relating to part D, which is the proposed packaging of sachets, something like that. So we'll read that. Any information that we may require elsewhere, we will look through the scenario as we do the question. Okay, so you're okay with that? So let's get going. I'll just share my screen. Okay, so here I can see. So this is the scenario. This is the question paper and exam. Okay, the scenario looks quite it's quite nice. It's giving a real scenario. So here you can get you can read the overview of the business and all of those type of things. I'm not going to read all of this because it doesn't take too much time. So what's nice about it, it's like a real scenario, like from a real world, right? It's probably a real world company that they kind of changed. So you get if you read this carefully, you'll get a good basis of how a hospital probably operates in Zimbabwe. Okay, so then they have the business model. If you read any financial statements, if not financial statements, if you read any annual report, at least here in South Africa, then you would have this business model. They will talk about these type of information, industry overviews, all of that you will kind of have an idea about. Then they ask you for part three, acquisition of Botswana healthcare. That is, I think it's part B, question on part B, valuations. And here they're giving some information to perform the valuations. It was likely have to do a discounted cash flow calculation, because if I look at the information given, it is looking like it's a discounted cash flow, whatever it's called. Okay. Now here we come part B. Okay, I mean part F. Part 4, which relates to required D. Okay, so let's say proposed acquisition of a new sachet packing line. So just a tip for you, you can see the scenario is very long. Now, if I just go back to the top, you see a 30 minutes reading time. Okay, so you have 30 minutes of reading time. Now, when you do the reading, we must make sure, because I'm assuming you get the scenario first, and only after the 30 minutes, you get your required. And I'm not sure if you're doing online writing or whether you're doing a remote writing or whether you're writing in a venue. So if you're writing in a venue, you will most likely only get the scenario, and then 30 minutes later, you get the required. In an online environment, I guess you get both at the same time. Now, what's important to take note, read the scenario in its fullest and try to get a big picture overview of the scenario in the 30 minutes. Okay, so use that 30 minutes to get a big picture overview. What you can see, what is going to be important in generally, is everything above point 3 is general information. You can see point number 1 is okay. There's no point number 1. Easier point. Yeah, point number 1 is the business model. Before the business model, just basically an overview of the company. Then they give you point 1, which is business model. Point 2, which is performance. That is still general to the company as a whole. Okay, and then you can see you have point number 3, which is specific relating to something, and then same with point number 4. So if you're going to probably need information that is general, we may have to look from above point 3 and up. So just get what you need to do when you read a scenario in its fullest, but try to get a big picture overview of what the scenario is telling you. In many cases, so I know, I don't know how you find it, but when I was a student, I used to read a scenario and I still didn't know what was happening, right? But as you practice and if you make a concerted effort, if you are, you make a conscious effort to read the scenario with understanding within the 30 minutes, not needing to read for an hour, take your 30 minutes, but try to get a big picture overview and avoid reading a scenario just for reading's sake. When I was a student, I used to read just for reading's sake, hoping I would get an idea of what's happening. Sometimes I did, most times I didn't. But try to get to a point where when you're done reading the scenario, you have an overview of what the scenario is about. And what's important to take note is these notes over here. This will guide you to answer a particular part of the question. Like I said, when I read, I saw part D and I immediately knew part D, we must come to point number 4. But take note, majority of the information will be over here. In some cases, all the information will be under that section. But in many cases, majority of the information will be under here, and there will be some information that will be elsewhere. Okay, so maybe under the general information. So just be aware of that. Not a lot of information will be under the general information, but there may be some information that we have to use from the general information. But like I said, most information will be over here. Now they are talking about proposed acquisition of a new sachet packing line. So let's have a look. If I click on the required, let me just see if you can see. Just give me a moment. Okay, so you should be able to see the required, which it says discuss with supporting calculation whether PTGS should purchase the sachet packaging line as proposed by the production team. So they didn't say calculate, they said discuss with calculation. Okay, so that means your main point is a discussion, but most likely you're going to have to do a detailed calculation. When we read the scenario, we will be able to see whether we need to do a detailed calculation or not. But the question you need to ask yourself, which topic are you falling with under? Okay, so which principles do you need to use? By knowing which principles you need to use, you kind of try to identify which topic you are within. So when it is a decision, so they say discuss with supporting calculations whether PTGS should purchase. So it is a decision. You need to help them make a decision. Okay, so whether they should purchase, so you know a decision needs to be made. A decision regarding what? It is the sachet packing line. So what you will pick up, a packing line would be a long-term asset, a long-term investment, a long-term project. What is a long-term asset, a long-term investment, a long-term project? It is a project that generates cash flows over a period of more than 12 months. Okay, so when a project generates cash flows over a period of more than 12 months, you know you are falling into the topic of capital budgeting. Okay, so just take note of that. When you need to make a decision regarding a long-term investment, then or a long-term project, a long-term asset, same thing, then you're falling into the domain of capital budgeting. So although we need to discuss, so I'm assuming many marks will be around discussion, we must still do calculation. So based on the scenario, we'll see what type of calculation we need to use. But remember, the general calculation for a capital budgeting question is NPV. Okay, so we'll have a look. But as you can see, they didn't say calculate with discussion. When they say calculate with discussion, generally calculation is the main answer. They say discuss with calculation. So discussion is the main answer. Okay, so just keep that in mind. So let's go back to the scenario. So they're saying the PTGS Executive Management Committee is in the process of evaluating a capital investment project that was put forward by the company's production team. The team is proposing the installation of a powder sachet packing line, which is expected to increase capacity and demand for citrus soda, an anti-acid medication. The following details have been provided in respect of the capital investment proposal. That whole first paragraph makes it clear that it is a long-term investment that you need to make a decision about, or you need to evaluate. So when you need to evaluate a long-term investment decision, or you need to make a decision regarding it, then you are falling within the domain of capital budgeting. Okay, so it's crystal clear. I don't know, I hope you can see it's crystal clear that you were in the domain of capital budgeting. Why? It is a long-term investment, a long-term project that you need to evaluate and or make a decision about. Okay, so you know you're in capital budgeting. When you fall in within capital budgeting, what you should know that you must, the techniques to help you evaluate it, the techniques to help you make a decision is NPV, IRR, discounted payback, and payback. So the superior one is NPV. Okay, so point one. The new sachet packing line is expected to cost $800,000 to purchase, with an additional $20,000 for installation costs. The packing line will have an annual production capacity of 1 million units of citrus soda sachets and is expected to have a useful life of 4 years, at which it can be disposed of for a scrap value of $100,000. In terms of the Income Tax Act, the cost of the new packing line ranks for capital allowances as it is machinery defined, and PTGS will always sought to minimize its tax exposure. The packing line will produce sachets of citrus sodas of 500 grams each. Okay, so that is the units. Okay, so that is the units. Yeah, okay, so just keep that in mind. So remember the tax aspect you guys are going to deal with. Unless it's very clear to me what it is, then I'll help you with it. But otherwise, I don't know what your tax rules. So if I'm going to attempt the tax, I may confuse you. But if I can see what it is clearly, I'll try to help. But for now, remember, I'll tell you where tax must come into play, what must come into play, but the actual numbers that you need to calculate, that I'll leave to you guys. Okay. So here is a few things that is being mentioned. There's a cost of the investment plus installation costs. Remember, if they don't tell you when the cost of investment happened, then you must know it will happen immediately, which is in year 0. Then they're giving you the capacity, 1 million, that is the capacity per annum. So 1 million sachets, we know each sachet is 500 grams. So 1 million sachets can be produced. That's the maximum capacity. It does not mean that it's the actual production. We probably have to see if there is any other details are giving us for actual production. And they're telling you we also picked up the useful life, which is 4 years. So that means the project lifetime is 4 years. So you're going to have a column for details, you're going to have a column for year 0, and you're going to have another 4 columns for year 1, 2, 3, and 4. And then they say at the end of 4 years, we will dispose of the investment and we'll make $100,000. You can also see there's some tax implications which you guys can deal with. I'll tell you what are the tax implications that you need to consider? The actual numbers, you guys you're gonna have to calculate it. The production management team have already performed preliminary feasibility studies on the viability of installing the new packing line and paid $15,000 to a consultant who assisted with performing the feasibility studies. The results from this feasibility study are as follows. Okay, so what is important to take note? What is important to take note is that they incurred a $15,000. That $15,000 is a sunk cost. Remember, one of the 5 principles of capital budgeting is that we only focused on future relevant cash flows. Now, we focus on cash flows that will still take place. Future means still have to happen. This already have taken place. So whether we go ahead with the project or do not go ahead with the project, that $15,000 have already been incurred. You still want to bring it into your capital budgeting calculation, but then you're going to put it in a 0, and in the column, you will tell them it is a sunk cost. That is why you are ignoring it. So remember, sunk costs, which is a past cost, a cost that will already have taken place, that must be ignored, because whether or not we go ahead with the investment, we have still incurred that $15,000. So therefore, it has no impact. It has no basis. It has no impact on our evaluation. Okay, so that is important to take note. That is the reason why sunk cost is not taken into account, because whether you go ahead with the investment or do not go ahead with the investment, the costs have still been incurred. So it has no impact on our decision-making process. So here they're giving us a range of information. Okay, so they're saying from the studies performed, it was clear that the consumers of citrus soda are price sensitive, as can be seen by the impact of different pricing levels to the expected demand, mainly because there is competing product to citrus soda currently in the market. Okay, so giving us different information over here. I guess there's one of 2 approaches you can go with this, right? There's one of 2 approaches you can go with it. Generally, this is got to do with risk and uncertainty. Okay, so with risk and uncertainty, you need to put a probability to it. So there's different ways to work it out. Either you take an average of all of these, right? And generally, the way you take an average is they would have assigned a probability. So you take an average of this information. So let's say there was 40%, 20, 20, 20. Then you take an average of all of that, and that will be your annual revenue. If it's not crystal clear what it is, then the next best opportunity would be to use the next best approach to use would be to work out which pricing level will generate the highest revenue. So if we say 250 times 1.5, we get a revenue figure. 3 times 900, we get a revenue figure. 350 times 750, we get a revenue figure. 4 times 730, we give a revenue figure. Then we can select the highest one, or you can select the lowest one, depending how you want to do it. Okay, so that is an approach. The typical approach would be that you would use an average using probabilities. They never gave us probabilities so far. So I would think we either use the highest value, the highest revenue, or the lowest revenue, depending. Okay, unless you know how they generally do it. I don't know if there's a general approach that CAA generally use, but if I might just think of it logically, the typical way is they'll give you probabilities. Then we must take an average using the probabilities of these numbers. That's the general way. They never gave us probabilities, so we kind of have to make a decision which one we're going to use. So you can either be conservative and then use the one that generates the least amount of revenue, because you know if that one is to happen and it's still positive, you're better off. Okay, so things like that we need to consider. Now, just take a note, when you work out the revenue over here, Here it is 2.5, and it can give us 1.5 million sachets. But remember, our capacity is only 1 million. So when you work this one out, you can't multiply it by 1.5 million. You have to multiply it by 1 million because our capacity is only 1 million. So just take note of that. Okay, so they say each sachet of citrus soda requires 0.5 direct labor hours, and currently PTG has an annual unused capacity of this labor force of 800,000 hours, okay, which is expected to remain constant over the forecast period, who are paid fixed salaries. So when you are paid fixed salaries, we don't bring that into account, because whether they are going to work or do not work, they're still getting paid the fixed salary. So therefore, that 800,000 hours is irrelevant. Okay, so it's irrelevant. So therefore, we do not take it into account. Okay, then they say that these 800,000 direct labor hours currently cost 300,000 per annum, with the cost expected to increase by 5% per annum for the next 4 years. If this packing line is purchased, PTG will have to employ additional labor, will be paid at an hourly rate of 50 cents. At the end of the 4 years, the additional labor will have to be retrenched, and it's expected that PTG will incur total layoff costs of $400,000. Okay, so we must only take into account the extra labor. Was they saying, so if you have a look, so here there's two types of labor: current labor and extra labor. Okay, so they're saying each sachet, okay, whatever, and currently PTG has an annual unused capacity of this labor force of 800,000 hours. So as you can see, we don't take that into account, because whether we go ahead with a project or not, we're still going to have it unused labor force, and we are still paying them. So therefore, we will call it is irrelevant. It is non-differential. Because remember, one of the principles is future relevant, future differential cash flows. Differential and relevant is the same thing. So something is irrelevant, something is non-differential when it will still be there irrespective of the decision. So for example, whether we go ahead with the decision or do not go ahead with the decision, whether we go ahead with the investment or do not go ahead with the investment, we're still going to have that 800,000 unused labor hours. So therefore, when we go ahead with the investment, we're going to use the unused labor hours, but we will not factor that cost into account, because we're already incurring that cost. So just take note of that. Okay, what we will factor is the additional labor that we will require, and we will factor the 400,000. The only thing we're going to have to factor in for the fixed labor is the increase of 5%. Okay, because we're currently paying 300,000, so we can factor in. We may have to factor in the 5% increase. Point number 4: raw material that will be used for the citrus soda currently costs 40 cents per kilogram, and each sachet requires 700 grams of this raw material to produce a 500-gram sachet of citrus soda. The current raw material cost is expected to increase by 3% per annum for the next 4 years. Currently, PTG has 40,000 kilograms of this raw material in stock, which were purchased at the price of 40 cents per kg. And if the packing line is not purchased, PTG will have to sell this raw material immediately at 30 cents per kg, as it is nearing expiry date. Okay, so when we use it, we're going to forego an opportunity cost of selling the current kgs at 30 cents per kilogram. The total production overhead costs are expected to be as follows. So based on the production level, we will have these amounts. of what we can do when you are given a when you have costs and you're given a range of information, you can see you're giving a range, then that means there's most likely a high-low method you have to do this. This is a mixed cost, which contains both fixed and variable costs. So then we have to do a high-low method to actually go ahead and calculate. Okay, that's it. Okay, so that's it. Okay, so that is it. This here is probably the information you're going to use when you work out, when you do part C, when you do part C for weighted average cost of capital. Okay, so now let's go ahead and go do this calculation. Now, remember, they have done, they said discuss with calculation. So our calculation is going to be a NPV calculation, okay? Our calculation is going to be an NPV calculation. But as you can see, there's lots of assumptions we need to make. So therefore, that is going to be the discussion, that we're making assumptions, okay? So what we're going to do, based on the revenue we choose, I don't know, you can tell me if there's an approach that your campus usually uses, but let's go with, we'll just select a revenue figure and we will have to justify why are we taking that revenue figure, okay? So, so just take a note of that. What I'm going to do, I'm going to just swap into Excel. I've created a group on Google, in my Google Drive. So I'm going to add you now to the group, and then you should have access. I'm going to do the calculation in Google Drive. So by me doing it in Google Drive and you having access to the drive, you will have, you will be able to access the workings immediately. Okay, then I'm not going to send the workings. You just go to the drive to fetch the workings. Okay, where is this now? I'm quickly going to add you to the group quickly. Okay, so what I'm not giving you editing rights. I'm giving you commentator rights, which means you won't be able to edit anything, but you can comment on it. And for you to edit, you will have to download the file, and it's only yours. So I want to avoid edits, meaning, so because remember, Google just automatically saves. So to avoid changes happening that I'm not aware of, I don't give editing rights. But when you download it, then you will be able to play around in it, but it's yours. It won't change what is saved over here. Okay, so I'm just opening up Google Sheets. Okay. Okay, so Google Sheets is open. You will see you got an invitation, but you don't have to go for it now, because you're going to see on my screen what we're doing. That is just for you to access it after the lesson. Okay, so going forward, I'll just save things there. Okay, so what I'm going to call it, what is this? The 2019, June 2019 exam, right? So this is the June 2019 exam. Okay, we're doing part D. Okay, so we're doing part D. So let's do the calculation. So remember, we need to discuss with calculation, but majority of the marks is going to be calculation. Remember, with capital budgeting, same with evaluation, you won't be able to do any discussion if you don't have a number, okay? But to get the number, we have to do the entire calculation, and then we will be able to provide a discussion, okay? So just be aware, but take note, discussion is the main aspect. So that just means you can't just give one-liner. You're gonna have to probably give a little bit more detail in terms of your discussion after you've done the calculation. So it is the June 2019 exam, right? So I'm fine with that. And we're doing part D. So remember, when we do a capital budgeting calculation, you always have two columns, details, and you're going to have here 0. Remember, and then we will have the useful life, which is year 1, 2, 3, and 4. Always remember that each column, year 1 represents the end of year 1. Year 2 represents the end of year 2 in terms of cash flows. Year 3 represents the end of year 3. Year 4 represents the end of year 4. So when something takes place at the when a cash flow happens at the beginning of year 3, you can't put it into year 3 because year 3 represents cash flows at the end of the year. So therefore, what will we have to do? Something happens at the beginning of year 3, we'll go into year 2 because year 2 represents the end of year 2. The end of year 2 is very close to the beginning of year 3. So it's basically the same. So the same thing with the cost of the investment. The cost of an investment you will need at the beginning of year 1. But you can't put it into year 1 because year 1 represents the end of year 1. So therefore, where do we put it? In year 0. So just get that thinking right. Remember, one of the 5 principles of capital budgeting is the timing of cash flows. So when you get the timing wrong, it is a problem because it is a principle you are getting wrong. Okay, so they are strict on principles. So just be aware of that. So they're always going to test the timing of cash flows. So remember, I'm just going to quickly do something. So I'm going to change the share. Okay. Yeah. So if you see now, if we go back to the scenario, back to the top. So remember, we are here now. So we know that the cost is 800,000 with a installation cost of 20,000. Okay, so if I just go here, it is cost of purchase, whatever you want to call it, cost of purchase. It is, what's the other thing? Installation costs. Now remember, it is an outflow, so therefore it's negative $800,000, and the other one was negative $20,000. Okay, so we're happy with that. So the best way to do it, as you read the scenario, you fill in. Okay, so remember, you're gonna, in your 30 minutes, you're first reading, but now when you come to part D, answering the question, you should have identified that part D is under that section over there, point number 4. So as you reread point number 4, you answer your question. Okay. Sorry. Now the next part is the packing line will have an annual production of 1 million. So you must keep that in mind. Your capacity is 1 million. So you can't exceed 1 million. And we know it's a 4 years. That's why we did the 4 years. And they say the scrap value will be $1,000 after year 4. So remember, I got the 4 years because I remembered when I read that part, there was it had a useful life of 4 years. If you did not know, you have to go back to go find what was the 4 years. Okay. Don't forget the annual production. Make a note for yourself, either somewhere on this page or on your exam paper, or a mental note. I have a mental note that I know the capacity is 1 million. So I had the 4 years. I've taken that into account. Now I need to deal with the scrap value. Okay, so whatever you want to call it, I'm just calling it scrap value. When do we get it? When does it take place? In year 4, at the end of the useful life. So therefore it's in year 4 because year 4 represents the end of year 4. How much are we going to sell it for? $1,000. Okay, we're getting $1,000, so therefore it is positive. Okay, and then they're telling us each packing line will produce 500 grams, and we know that they minimize the tax exposure. Okay, so you would know what that is all about. Okay, number 2, the production management team have already performed preliminary feasibility studies on the viability of installing this new machine line and paid $15,000. Okay, so that's a feasibility costs. So remember we said the feasibility costs, it was already incurred, so we're going to put in 0. Why? So you can either just put it over here, you can have a separate column called comments. So here you can just put it in by saying it is a sunk cost. Remember, how do I know it's a sunk cost? We have already incurred it. So whether we go ahead with the investment decision or not, that $15,000 have no impact because it has already been incurred. Okay, so therefore we don't include a sunk cost because it has no impact on the NPV calculation. There's no impact on our decision because we have already incurred the costs. Okay, so that was now we have to decide which one we're going to use. Remember, if they gave you a probability weighting, then we're going to take the average. So what we will do over here, we'll work out, then I'm going to select the highest one, okay, or we can select the lowest one we can see. But let's have a look. We are looking for the calculation. Okay, so I'm going to have workings over here. So what I'll just do, so on that workings, white, wanted to be bold. Okay, so here we're going to have workings. So I went over here. Okay. Okay, so working 1. Okay, so what do we have? What did we have now? We just go back. We had selling price and expected and demand. Okay, expected demand. Okay, so selling price per sachet. Okay, annual demand as an expected annual demand. Okay, I'm not going to still put the word expected. So this will give us revenue. Okay. So it was 2.5, then I think it was 3, then it was 3.5. Just make sure I'm putting it right in. Then it was 4. Okay. Over here, it was 1.5. But remember, our capacity is limited to 1 million. So therefore, we just make it 1 million. Okay. Then what was it? Let me just go check. Okay, 900, 750, 730. 900, 750, 730.
750, 730.
900, 750, and 730. Okay. I'm just going to do that. Okay, so now our revenue is going to be that is going to equal that 250 times 1 million. Okay, so that's going to generate 2.5 million. Okay, so 2.92. So let's go with the, you can decide. Remember, if they gave you a probability, you have to work out, let's say it was 10, 20, 25, 25, 25, 25% probability. You take this total number and you multiply by 25, you get a weighted, you get a weighted probability. Then same 25, get a number, get a number, get a number, and then you add up the total. That's if they gave you a probability. That's a typical way of doing it. But they never gave us a probability, so we have one of two choices. Either choose the lowest number or the highest number. Let's go. If I was a company, I would choose the highest number. Okay. So then we're going to say, just make a note. Revenue based on 730,000 units as this generates the highest revenue. Okay, so a company's going to do that. They're going to choose based on the highest revenue. All they will do in addition to this, they will just do then, because there's different options, right? So now all they're going to do, they're going to produce at 730,000. They're not going to do more than that, because then they know they're going to get the highest revenue. So why produce 1 million if you're only going to get 2.5 million? So let's just produce at 730, because that's going to generate our highest return. I hope that makes sense, because when you make a decision, when you run a business and you make a decision, you're going to choose the one that produces the highest revenue. At the same time, you'll also look at what value you're providing to your customers, but you'll also look at the one that will produce the most revenue. Okay, so just take note of that. Then we just want to make mention with the annual demand with $250. The demand limited to 1 million as that is maximum capacity. So we can't use 1.5 million. Okay, so remember, let me just change this. If I change that to 1.5 million, you can see it generates the highest revenue. But what's the problem? We won't be able to generate 3.7 million revenue, because we can't produce 1.5 million. We can only produce 1 million. So very, very important. Okay, many students have just used 1.5 million because they've missed the point that there's only 1 million capacity. Okay, so please be aware of that. When you see capacity, make a mental note somewhere or write it somewhere, because that's going to come into play somewhere. Okay, so now we can put in our revenue, and revenue is going to be that one. So I'll use working one. Okay, so there we have working one. Okay, now we go back to the scenario. Okay, so that is the feasibility of the revenue. Okay, happy with that. Okay. Now point number 3, each sachet of citrus soda requires 5 direct labor hours. So now remember, we have selected 730,000 units. So we must base it on 730,000 units. Okay, so let's have a look. Okay, so let's work it out. So if I go to working 2, So I go to working 2. So let me just say details amount. Okay, so remember, what did I just read? Labor hours, each session, labor hours per unit. So here we have labor hours per unit, which is 1 sachet. So it was 0.5, okay? Annual demand. Remember, we selected the revenue based on 730,000. So we must use 730,000. These, what you use over here, must correspond to what you have used in your revenue calculation. Just be aware of that. Okay. So this will give us required labor hours. So this will give us required labor hours. Okay. So required labor hours. Okay, so it's equal to 0.5 times 730,000. Okay, so we just quickly have a look if we're doing this right. So each citrus soda requires 0.5 direct labor hours. Okay, which is expected to remain constant for Foco, who has fixed salaries. These 800,000 direct labor hours currently costs $300,000 per annum, with costs expected to increase by 5% per annum for the next 4 years. If the packing line is purchased, PTG will have to employ additional labor who will be paid an annual hourly rate of 50 cents. At the end of the 4 years, the additional labor hours will be retrenched. Okay, so I guess we will have to work out the additional labor. Okay. Okay, so if the packing line will have to employ, will be paid an hourly rate. Okay, so that's fine, an hourly rate of, that's fine. Okay, an hourly rate. Okay, so that should be fine. I don't think there's any increase. Is an increase. Okay. So what we're going to put in there, current labor. We're going to put in current labor, which is 0. Why is current labor 0? Because it is irrelevant. Why is it irrelevant? We're still paying their costs, whether we have we're still incurring their costs, whether we have the plant or not. So just please be aware of that. Whether we have the plant or not, we're still incurring their costs. So therefore, there's no need to put in an amount. What's important to take note that you must tell them why you're making it. You can't just leave it out. You must tell them. So we're saying it's 0. Why is it 0? Irrelevant. What does irrelevant mean? That whether we go ahead with the investment or not, we're still going to incur these current labor costs. So therefore, it is not it's not relevant in our decision-making process. Then we're going to say additional labor. Additional labor. Okay, and then we're also going to have retrenchment costs. Okay, retrenchment costs. Retrenchment costs at the end of 4 years, we're going to incur 400,000 as an outflow. So we're going to say 400,000. Okay, now let's work out the additional labor. It's going to be working 2. So each labor units, 0.5, annual demand 730. So the labor hours required labor hours, 365. Are we happy with that? Does that make sense? Now, costs per hour. Labor costs per hour. I see 0.5. Let's go back. Labor cost per hour, it is 0.5. If this packing line is purchased, so each sachet requires 0.5 direct labor hours. Okay, we're happy with that. Okay, so they're saying if this packing line is purchased, we'll have to employ additional labor who will be paid at an hourly rate of 0.5. Okay, so hourly rate $0.5. So that will give us our labor.
Sorry,
Yes.
sorry to interject. Okay. When I read that part, I was actually thinking that our required labor is 365,000. Hey.
Yes.
So now they're saying we have unused capacity of this labor force of 800,000 hours.
Yes.
So doesn't the 365 get into the 800,000? Like we don't need
that is what I would have done. That is what I would have done. So you are spot on over there.
Okay.
But for some odd reason, they don't do that. Okay. If I had to do this question paper without using your solution, then I wouldn't have taken into account the additional labor because there's spare capacity. There's spare capacity.
Yes.
But I am assuming that they are trying to tell you that because they're taking into account, perhaps they are saying over and above that spare capacity, we still need additional labor. That is what I'm kind of reading from it.
Okay.
I wouldn't have done it if it was not for the solution, but I see the solution taking into account. So I'm assuming the only thing I can assume is that they are saying the fact that they are using the word additional labor, that you need it, kind of thing. That is the only thing I can assume. So you are 100% spot on. I think probably that's one of the things within the scenarios that I've picked up reading the various scenarios. It's not 100% clear. So I've read a few of your scenarios already, and many a times it is not 100% clear. So it can go either way, you understand? So I guess the only way you would know, like the only way I would know, so going forward, I would know they'll take this in because what I can pick up when they're telling you something's additional, you must take it into account. So I've picked it up from a few scenarios. But if, for example, I guess, I don't know if they send this to moderators, you understand? So like I said, I remember one of the lecturers at UCT saying he was, when he set the paper, he sent it to, then it needs to go to one of the professors. So he sent it to the CTA professor. She's no longer at UCT, but he had to send it to her, and then she reviews it. He said when he came out of her office, his whole paper was changed, not in terms of the principles being tested, but in terms of how it is worded.
It's worded, okay.
She showed him that by the way you're wording it currently, it's leaving and making it very ambiguous for a student. A student can think this, that, or that. But if you word it like this, there's only one way that they can think about it and the way that you want them to think about it. So same thing over here. I guess it's someone that never sent it. So when I'm reading it, I'm thinking that, okay, we have spare capacity. We need 365. Therefore, there's no labor required. But when you look at the solution, they're taking the additional labor into account. So what I can take from it is as follows, that they are testing whether you're taking in the current labor, and you mustn't take the current labor in because whether or not you incur it, whether or not you go ahead with the investment, you still don't need, you're still going to incur the current labor. So they correctly show current labor, you don't take into account. But now with the additional labor, for me, we don't need the additional labor because there's spare capacity. But I guess the fact that they are saying that you are employing additional labor, you must take this, because I guess they can argue by saying, they are saying that if you go ahead with the investment, you are going to employ additional labor. So that is the only way you can think about it, that they are saying, when you go ahead with the investment, you're going to employ additional labor, so you have to take the additional labor into account. That's the only way I can explain it. But like I said, if I do just from start to finish without looking at the solution, I wouldn't have taken into account the additional labor. But
Okay,
now what you must take from this, that is when they tell you additional labor will be incurred, then just take it into account. Okay, I hope that makes sense. That's the best I can help you with.
okay, that's fine. Thanks.
Hello, Faiz.
Yes.
Sorry, sorry to disturb, but I didn't see the solution. I'm only seeing what you're doing. But is it, I just had a question. Probably they were using the $2.51 and the 1,500. That's why they're taking into account the extra labor, because they will be saying we have extra 500 to make. Probably, I'm just thinking maybe I could be wrong. I didn't see the question or anything. Which one did they take as the revenue? Is it the $4 one or the $2.51?
$4.
The $4.
Yeah.
Yeah. So indeed, it is confusing. Thank you very much.
Yeah. So it's I guess it's just the
Yes, also.
the wording. That's the only thing. Like the scenario is brilliant. I must say, the scenario is really good. But just obviously, the wording of the scenarios in like so far in all the ones I've read is ambiguous. You understand? But from that, for me, I can pick. I kind of know now what to do if I see it, because I know. So you see, what you learn is when you go through various scenarios, you learn how the examiner thinks. So now I know how they think. So when I'm going to read it again, if I get another different, a new scenario, but a similar thing, I'm going to know what to do because I know what they now mean. So that is what the benefit now, unless they become, they've improved where the scenario is very specific, but then you wouldn't have it ambiguity. Yeah, I think Tao, you wanted to say something.
I wanted also just to comment to say, in terms of we are checking on the answer, for example, if you look at the cost or the labor cost that they've put 25 cents, but they mentioned it was 50.
Yeah, that's why I know. Yeah, that's why I'm still using 50 cents, because I don't know where they got the 25, and I'm using 50 cents. I was gonna mention that just now. So when I don't follow a solution blindly. So I'm using 50 cents because I can't see where they're getting 25. I can interpret. I kind of probably know what they have done to get to 25, but it doesn't make mathematical sense. So therefore, I'm still sticking with the 50 cents.
Okay, what I'm thinking is, can't we just do the principle and put our assumptions and not follow through the solution? I don't know what you guys think, because sometimes the solutions at CAA are very confusing. So what we need is the principle, because in the exam, honestly, I can justify why I didn't take into account the additional labor. And I'm sure I will still get 100%. Yes, and I'm sure I'll still get marks. So 100%. I think first, just take us through the principle, because this thing of putting additional labor will extremely confuse us.
Yes, so
so I think we should just put 0 on the additional labor.
No, but you see, the argument would be, so although there is additional labor, right? So can you see the scenario?
Mm-hmm.
Okay, so the argument would be, if this packing line is purchased,
mm-hmm.
PTG will have to employ additional labor.
Oh, okay, yes.
So that will be the
So it's sort of like
argument.
they must employ additional.
Yes, they will have to employ. So if they said, if additional labor is required, then they're not saying if this additional labor is required. They're saying additional labor will be required. Okay, so that
Okay,
is
okay.
basically the thing. The only aspect what I'm not changing is I'm not changing that to 0.25. So I don't know where the 0.25 come from. I can just assume that they are saying each labor is taking 0.5 hours. That's why they probably divided by 2, but we're already taking into account that. So I'm just sticking with, for me, mathematically, it makes sense, 0.5 labor. So 0.5 labor. So you're taking a half an hour. You're taking an half an hour per unit. Okay, there are so many units. So that is the number of hours. Each hour is 50 cents. So I would think that is what I would think. Okay, so that's why I'm not using the 0.25.
Okay, that's fine.
So once you look at the solution, my answer will be different. So I don't know where they got the 0.25. I'm just using logical thinking. And I hope you can see this does appear logical to me. Okay, so I'm going to use what you call it. So if we go to additional labor costs, it is equal to C29. Okay, so just take note that the thing that Tao raised is important to take note. So when they give you, so this is a typical thing, but it will generally come through when you do cost accounting in relevant costing. So in relevant costing, cost accounting, which fall under the cost accounting banner, you will have a situation where you have spare capacity, right? And you only take into account, let's say in labor, you have spare capacity of labor, you'll only take into account labor costs that is in excess of the spare capacity. So in this case, we most likely wanted to, we wouldn't want to take in additional labor because we only need 365,000 hours, yet we have 800,000 hours available. So why are we still taking additional labor into account? Because as the way it's worded, if they had to say that additional labor will have to be incurred if we exceed the spare capacity. So let's just assuming that, right? Something of that wording. It can be worded differently, but if the message is basically saying you're only incurring additional labor if you need additional labor, then in this case, we wouldn't have taken additional labor into account because we only need 365 hours, yet we have 800,000 hours. But in this case, they didn't say if we need additional labor, we will incur additional labor. They're saying when you go ahead with the investment, with the purchase of the packing line, you will incur additional labor. So that is why they're not giving us a choice. That is why we have to include the additional labor. So just take note. Okay, so please take note of that. And then as a result of additional labor, we will go ahead with the retrenchment costs. Okay, so please, wording is very important. That is why, like in the field of accounting, a lot of people, I was one of those people when I was a student, actually before I joined university. Why do I need English to go study accounting? But as you can see, the English part, whatever language, I'm assuming, Zimbabwe also using English, because I can see over here. So the English is important, right? Your language does play a role because not being able to understand, read the scenario, you won't be able to really do well, if I can put it that way. So I also, when I applied, I was like, why do I need English? You understand? But when I went up in my studies, I realized that English does play an important role. Okay, so that is that. Now we come to the raw material. So they say raw material that will be used. Yeah. Any question? No. Raw material that will be used for the citrus soda currently costs 40 cents per kg, and each sachet requires 700 grams of this raw material to produce a 500 gram sachet of citrus soda. The current raw material cost is expected to increase by 3% per annum for the next 4 years. Currently, currently PTG has 40,000 kgs of this raw material in stock, which were purchased at the price of 40 cents per kg. Okay, so we've read all of those. So let's go do the calculation. So remember, we have 730,000, 730,000 units. Okay. So working 3. So we're going to work out raw materials. Okay. So annual demand. Annual demand. What is annual demand? It is 730,000 units. Okay. Kilograms per sachet. Now remember, there's 1,000 grams in a kilogram, right? So each sachet requires 700 grams. Now we want to convert this into kilograms. So we're going to say each sachet requires 700 grams. But we want this per kilogram. So we divide it by 1,000 because one kilogram equals 1,000 grams. Okay, so therefore it is 0.7 kilograms. So this will give us the total required kilograms. Okay, so this will give us total kilograms. Okay, so total kgs required. Okay, so it's equal to that multiplied by 0.7. So there we go. We require annually 511,000 kgs. Okay, so now we can work out the raw material costs. So working for the raw material costs, so we're going to have details. Okay, so we're going to have year 1, year 2, year 3, year 4. Okay, kgs required. Okay, kgs available. Okay. Okay, so it will give us our kgs. Okay, so I'm just going to say net. I mean, you can call it whatever you want to. Net kgs required. Okay, cost per kg. And then we have increase rate, total cost. Yeah. No, I'm not going to do that. I'm going to call this here total cost over here. Total costs. Okay, so the kgs required will remain 511. Because remember, 730,000 kgs, 730,000 units every year. So it will remain the same each year. Okay. But currently we have 40,000 kgs on hand, 40,000 kgs on hand. The others will be nothing. So 0, 0, 0. So the net kgs will just be that minus that. Okay, so let's just do this. Okay, the current, let me just go see again, can't remember total cost. So they said, where did I see that? Raw materials will be used for the certain currently costing. So it's currently costing 40 cents per kg. Okay, so it's currently means year 0. When you see the word current, When you see the word immediate, then you know it is year 0. Okay, so therefore, from year 1 onwards, we must already do the increase. Okay, so from year 1 onwards, we must apply the increase. Okay, so I'm going to say here, increase at 3% from year 1. Okay, so from year 1, you must apply the increase. Why? They said currently the cost is 40 cents. Currently is year 0. Currently is now. Currently is immediately. We're working with year 1, which is next year. So therefore, we must apply the increase immediately. Okay, so it is 0.4 multiplied by 1.03. Okay, 1.03. Okay, so that is the cost. And then each year we apply, we're going to say that multiplied by 1.03. So each year is going to increase. Okay, so now I can work out my costs. Okay, I don't know, we can check now the solution. I don't know if the solution did that, but we can do so. This is raw material. Okay, so it's equal to, so remember it's a cost, so I'll make it negative, equal to that. And I'll tell them they can go have a look at working 4. Okay, so there we go. I'll just say they can get this from, they would see, but just to make it easy for the examiner, oh, sorry, not that, Control X, Control V. Okay, they can get it from working 3. Okay. Then, now remember there's an opportunity cost. So now we must put in here opportunity costs. Opportunity costs. This relates to sale of current kgs. Okay. So remember we are losing out on a current sale. So we currently have 40,000 kgs, right, on hand, and we can currently sell it at 30 cents. But if we use it in the process, we won't be able to sell it. So we're losing out on $12,000. So we make it negative. Okay, so you're happy with that? There's an opportunity cost, sale of current kgs. Okay, maybe just loss of sale of current raw material. Okay, so remember we have raw material on hand, 40,000 kgs. We can currently sell it for 30 cents per kg. But if we use it in the process, we're going to lose out on the kgs. Okay, so just take note of that. So how do you choose that one? And remember, you can choose whether you want to sell it or not. You're only going to get 30 cents. So why must you go pay 41 cents if you can use the current one? So just think about that. Okay, so you're only losing out on 30 cents, whereas if you had to buy, you'd lose out on 41 cents. So that's why we choose the to rather forego the sale. Okay, so just be aware of that. So let's go back to the scenario. Now we must work out the total production overhead costs are expected as follows. So now that when you are given a cost and you see a range of information, when you're given the cost and you see a range of information, so here you can see, so if you get 2 types of information, the total cost as well as the units for a range, then you must know it is a mixed cost. Okay, so here you can see they're giving us a range of information that includes total costs and that includes the units for each level of total cost. So therefore, you must know this is a mixed cost. So whenever you see that, they are telling you this is a mixed cost, so you must use high and low to separate fixed from variable. Okay, so if I go back to the scenario, we want to put in here, fixed production costs and then variable production costs. Doesn't matter which order. That came first to my mind now. Fixed production, variable production. But now we need to go work it out. Okay, so we're going to use the high-low method. So working 5. So for working 5, we can use the high-low method. So while we're using the high-low method, they gave us cost information. They gave us a range of, for the same cost, they gave us a range of information. They gave us a range of units and the cost for those units. So that means they indirectly telling us it's a mixed cost. So therefore, we need to split it out to find what is the fixed, what is the variable component. And the way we do that is using the high-low method. Okay, so we have, so what we will have details. We will have a column for costs, and we're going to have column for units. Okay, then we're going to have high, and we're going to have low. Now the high and the low is based on the units. Okay, not on the cost. The high and the low is based on the units, not on the cost. So what is the highest units? The highest units in the range of information is the 1 million. The lowest units is the 700,000. Okay, so we'll do that. Come on. Okay, someone can just help me quickly. So the highest units is 1 million. The lowest units is, what was it now? 700,000. Okay.
700.
And what was the
Then
cost
the
for
cost
the
high is 550.
550?
Mm.
Yeah. And low?
And the low is 505.
505. Okay.
Mm.
Low.
Okay, there we get the difference. Okay, so the difference, we just subtract the two from each other. So that minus that, okay. Okay, so what we will do to get the variable costs, so the variable costs, okay, so the variable cost is equal to change in costs divided by change in units. Okay, so remember, so to get the variable cost, we need change in cost and we need change in units. Okay, so here we have change in costs is the 45,000, change in units is 300,000. Okay, so the variable cost is change in costs divided by change in units. So therefore the variable cost is 15. It is variable costs per sachet or per unit is 15 cents. So to get the total variable cost, it will be equal to variable costs per unit multiplied by number of units. Okay, so what's our number of units? 730,000. Okay, so therefore total variable costs is going to be variable costs per unit and then number of units. So remember, number of units is based on the number of units we're producing. The number of units we're producing is basically equal to the number of units that we're going to sell, which is the 730,000. Okay, number of units, let me just make this clear, number of units produced. Okay, so the variable cost, 15 cents, the number of units we're going to produce is equal to the sales units, 730,000. Oh, 730, 1, 2, 3. Okay. So it's equal that multiplied by that. So that's our total variable cost, 109. Okay. Now we can get our fixed costs. Fixed costs is equal to total costs. Total costs minus variable costs. Okay. Just so you know, from a management accounting point of view, total costs equals fixed costs plus variable costs. So if you rearrange the equation, you get fixed costs equals total costs minus variable costs. Okay. So to get fixed costs, we need total costs and we need variable costs. We already have variable costs. Variable cost is the 109. Now you can decide, sorry, we don't have the variable costs. Sorry. Now you can decide which one you want to use. Okay. So you go with the high. Okay. So I always just go with the high. So if I use the high information, based on high information, total costs is 550. Okay. So based on the high information, total cost is 550. All I need to do now is to work out variable cost. Now remember, variable cost per unit is 15 cents, and I used the high information. So the number of units for high is 1 million. So therefore my variable cost is whatever it came to over there. Let's just see what it came to. It is 150. So my fixed cost is going to be 550 minus 150. So my fixed cost is 400,000. If you use the low, you'll get the same information. I'll just do it on the side just to show you. So you must decide which information you want to use. So to avoid me thinking in the exam, I always just go with high. Okay. So now just to show you, using low, you'll get the same thing. So if I use based on low information, my total cost is 505. I worked out fixed variable cost per unit. Variable cost per unit is 15 cents. So using the low units, it is 700,000. So it's 105. So if I work out fixed cost is total cost minus variable cost, end up with 400,000. Okay, so whichever information you use, you should get to the same answer. So now I can just go. So my fixed cost is C65. My variable cost is C60. So if I go fixed cost, it is as a negative C65. And my variable cost, it's also negative. It was C60. Okay. So now I can just drag this across. I can say they can go find it at working 5. You can just look at working 5. Okay. So if I go back to the scenario, there is nothing else. So therefore, we're good to go. So the only thing you're going to have to bring through, so I'm not going to deal with the tax component, so you have to deal with tax. What you need to know, that every line item over here has a tax implication. So you know how to deal with the tax from a the costing and the scrap value, because obviously there's this minimize of tax. I don't know how that works with from your guys' perspective. What to do? So this will give me my net cash flows. Net cash flows, if I add it up, remember mine now is out, mine doesn't include tax, but yours will have to include tax. I'll just do a quick I'll give you a high level overview of the calculation you will do. So I'll put in here working 6. It will show working 6. Let's just do that. Okay, and then remember, you must have a discount rate. We don't want future cash flows. We want the present value of the future cash flows. The way you get your present value of the future cash flows is to use an appropriate discount rate. The appropriate discount rate for a capital investment decision, for capital budgeting is the WACC rate. Now, I'm assuming the WACC rate to use from above. So I'm just going to make up a WACC rate for now, 15%. Remember this, just to make it clear, the WACC rate is made up. It is not the actual WACC rate. You must use the WACC rate that you do in part C. Okay, so now this will give us NPV. Okay, so if I'm assuming, so this is Google Sheets, it's not Excel. So they may be slightly different, but I'm assuming it'll be the same calculation, NPV. Okay, looks like it, yep. So what do they want? Okay. NPV 8, okay, cool. Cash flow 1, cash flow 2, okay. So NPV, okay, so let me just actually change this. Delete. No border. So I'm just going to put the PV cost. And then this will give us, NPV. I'm just doing it a little bit the longer way because of the way the calculation, the way the spreadsheet works. Okay, it'll be different on a financial calculator. Okay, so let me just say equal. So just to make it clear, when you do the NPV calculation, so just have a look what the Excel does. Okay, so both on Excel and on Google Sheets, when you do the NPV calculation, they want the discount rate. We also want the discount rate when you do the financial calculator. But here's the difference. Excel and spreadsheets don't start from year 0. They only start from year 1. Okay, so we take year 1, year 2, year 3, and year 4. Okay, so they're giving us this number of 5.5 million. But the 5.5 million is not your NPV. Your 5.5 million is present value. This is only taking into account those. Okay, so now we need to bring in our initial costs, which is that over there. And when I sum this up, we now get NPV. On a financial calculator, slightly different. A financial calculator starts with cash flow 0. So therefore, when you type in your numbers on your financial calculator, you will end up with your 4.7. Okay, on Excel or on a spreadsheet, on Google Sheets, we won't end up with 4.4, 4.7. We won't end up with 4.7 because I don't take the cash flow year 0 into account. So just be aware of that. So for that reason, I include this extra step. Okay, so just be aware of that. Just to show you your tax calculation. The tax calculation will basically, if I put in here working 6, we have details. We will have year 1, year 2, year 3, year 4. Okay, so there will be a wear and tear allowance. The wear and tear allowance, whatever you want to call it, is the tax deduction from an income tax perspective relating to the investment. Okay, then you have your installation, which will most likely be the same for the wear and tear, and then you have your scrap value. Now, I'm assuming these 3 things, you have a special way of doing it in order to minimize tax. Okay, so you need to work on that aspect. I don't know how that works. Then you might just bring in the remaining. Okay, so the remaining, you just bring in all of these. Okay, so if you bring in all of these, you can just say equal. I'll just go fetch it and I'll say it's equal to equal to that revenue. Okay. And then you can bring in the opportunity costs as well. You must always bring in the opportunity costs. The opportunity costs. So remember, although the opportunity cost happens in year 0, what's important to take note, tax only happens at the end of the year. That is why, so the opportunity cost happens at the beginning of the year. So therefore we put it into year 0. But the tax consequences only happen at the end of the year. That is why, although this cash flow happens in year 0, the tax consequence takes place in year 1. Same with the investments with these over here. The wear and tear happens in years. I mean, the cost of the purchase happens in year 0, but the tax allowances probably only happens from year 1 onwards. Because I don't know the tax allowances, you have to deal with that. You know. This then will give you your taxable income. This will give you your taxable income. Then we're gonna have tax. What's your tax rate? What's the tax rate? Tax
25.
35. 25.
25.
Tax at 25%. Okay, so the tax at 25%, that is what you are looking for. Okay, so this is what we are looking for. Tax at 25%. So if I add up all of these, okay, so with the wear and tear, you know what to deal with the wear and tear. I don't, unfortunately. All you do is you change the sign. So you say negative, that multiplied by 25%. So why does this make sense? I'm going to show you now. So remember, when you have a positive, it means there's a taxable income. So therefore, you're going to have to pay SARS. So by changing the sign, it shows it is a negative. Okay, so then you take the answer as is. So if I go, so that is C85. So if I go over here, I take the answer as is, equal C85, it's already an outflow. Because it was a taxable income, I expect an outflow. If it was a taxable loss, I would expect an inflow, then I would expect it to be a positive number. So what you just do, when you work out the tax, you take taxable income, multiply by 25%, but make sure that you say negative taxable income times 25%, you already get the correct sign. And then you drag this across. You'll obviously change this number. The number is not 100% correct because I didn't factor into account these tax rules over here. Okay, so you know the tax rules for that, so you can implement that. Okay, so that is from my side. I hope you found this beneficial. I hope you understand what we did over here. Is there any questions that you may have? Tao, any questions from your side? Eddie, any questions from your side?
Not from my side. Thank you.
Okay, okay, Tinashi, you're
Yes.
on. Okay, Edmo, go.
Yes,
No, I don't have a question.
Okay,
Thank you.
Tinashi.
yes, I have. I just want you to repeat on the revenues when you were saying we use probabilities. I missed something there.
Okay, I'll come to that now.
Yeah.
Evangelista.
I have no questions, sir.
Okay, Justin.
No questions, Pius.
Okay, Kudzai.
No questions, all good, thanks.
Okay, Walter.
No questions for now. Thanks, Pius.
Okay. We found the class beneficial. I hope it was useful. Hope you learned something. To answer Tinashi's question, so the probability, so generally, what would happen, so this is different in this scenario, okay? But what would generally happen, they will tell you, you have this investment that you want to make, and these are the revenues you can earn, okay? So they could give you the revenues in the same way they gave us demand times price, or they could have just given us a revenue figure. Let's say you could either earn R1 million, $1 million, $2 million, $3.5 million. Okay, just so for example. But then they say the chance or the probability of making $1 million is 50%. The probability of making, what did I say, 2 million is 30%. The probability of making 3 million is 20%. Okay, so the probabilities would add up to 100%, would add up to 1. So then you must take the weighting. So you will say 1 million times 50%, 2 million times 30%, 3 million times 20%. You get the answer for each of those. You add up the 3 probability answers, and that will give you your revenue figure. That is when you work out, either give you a probability situation. In this case, I never. We had to make a decision which one we're going to choose. Any company will choose the option that will give them the highest revenue. Okay. I hope you find it beneficial. I hope if there's any question, you can let me know. Does that answer your question, Tinashi?
Yes, you did. Thank you.
Okay. So that is for it for today. Tomorrow we'll have to do a double session tomorrow because we have 2 lessons left for FAC. There shouldn't be any load shedding tomorrow, but I do think there's load shedding today. That is why I didn't want to do extra lessons. It just cause confusion when we have to change every time. So load shedding is supposed to have ended yesterday, but because there was some government thing that happened, they postponed load shedding yesterday. So I think it's being done today. So yeah, so then hopefully they shouldn't be tomorrow. So that we can do it double tomorrow, but we try to do it early. Not like the second lesson, we try to do it like about, I don't need to chat with my wife, but we try to do it also quite early, give maybe like an hour and a half break, and we come back. I'll just chat, but I'll confirm with you later today for the second lesson. But the first lesson will be the same. Unfortunately, I wanted to do the second lesson today as well. So we don't have too many lessons tomorrow. But because of load shedding, just better if I have it tomorrow. Okay. I hope you enjoyed the class and it was beneficial. If you have any questions, just let me know. I'll be glad to assist you guys. But otherwise tomorrow, and then we'll finish off with FAC. Okay.
Sorry,
yes.
I didn't get how we are going to go on the Google. We are not very good with these tech things.
With?
How do we access the Excel?
You should have gotten an email to say that you have, I shared a link with you. In the email, there'll be a link. You just click on the link and it'll take you to a Google Drive that is CAA student, whatever I called it, and then you will find the spreadsheet in there. Okay.
Okay, thanks.
Okay, I'll send this as soon as it's done loading. As soon as it's done recorded, and then I will load it onto YouTube, then I'll share it with you. I know Justin asked for some extra. I'll send IS-12. One of the, I think I only have one more IS-12 question. I'll send that as well. Okay. But once it's obviously
you.
it's IS-12 for CTA, South Africa. Okay, guys. Okay, so,
Thank you very much, Faiz.
okay, pleasure. Okay, bye-bye.
Thank you very much, sir.
Bye-bye. Thank you, pleasure.
Bye, thank
Bye.